Yes, welcome to Veranda CA. A very pleasant morning to everyone. Today, as part of chapter number 12, we will be discussing audit under fiscal laws, right? Advanced Auditing and Professional Ethics, paper number 3, audit under fiscal laws, chapter number 12. So, in today's discussion, we will be having the different tax audit clauses. I'm sure you guys will know about Form 3CD. Maybe you would have studied in your, you would have done tax audits. Tax audit is from the year 1985. If you remember, this tax audit was introduced under the Income Tax Act from the year 1985 and it is continuing till today, right? So right now there are, at that point in time, there are very minimal clauses. Slowly as things started improving, as you know, more and more transactions start happening today, the number of clauses started to increase, and as at today we have 44 clauses that are there as part of this Form 3CD. Okay, just a brief overview, right? 3CD, 3CA and 3CB, right? 3CA and 3CB is basically the tax audit report that the auditor gives, the audit report that the auditor gives under the Income Tax Act. 3CA is for those assessees, for those taxpayers who are required to do audit under any other law other than the Income Tax Act. For example, if it's a company, you are required to do audit under the company law. If it's an LLP, you may be required to do audit under the LLP Act. So in that case, for such assessees, you will issue Form 3CA. For the others who are not required to do audit under any law other than the Income Tax Act, then you will have to issue Form 3CB. This could be a simple MCQ. I'm sure you guys will know, if because most of you, since it's addressed to the CA final students, you would have done your articleship. As part of your articleship course, either in a Big 4 or a mid-sized firm, you may have done tax audits, right? So you will have some idea, fair idea about what these what this clause is, or what this tax audit is all about. So that is on 3CA and 3CB. So what is 3CD? 3CD is a mandatory form. 3CD is a mandatory form that any assessee who's required to do tax audit under what section, sir? I'm sure you guys will know, under section 44AB of the Income Tax Act. So this is the charging section for the applicability of the tax audit under the income tax law. So if you are required to do the tax audit under Income Tax Act under section 44AB, then this form will come into play. Whether you are a 3CA assessee or a 3CB assessee, 3CD is a mandatory form. So what is 3CD? Basically, it's like a checklist. You have 44 clauses. Some clauses have multiple sub-clauses also. So in essence, you have multiple clauses which you will have to fill. Who will have to fill? The assessee will have to fill. In fact, in practical sense, the auditor only fills it. The tax auditor will have to review that, and then basis that, Form 3CD along with the Form 3CA or 3CB, as the case may be, will have to be submitted to the income tax portal, in the income tax portal online. And after that, you have to file your income tax return. Okay. So what happens after this particular clause, this particular 3CD helps the income tax department to assess the income tax. To suitably assess, to suitably see whether the income tax return that has been filed is in line with the income tax audit report. Clear? So with that, so in today's session, we will be covering all the 44 clauses. We will be covering all the 44 clauses, clause by clause we will be covering, and wherever questions are relevant from an examination perspective, we will be covering that also. So in today's session, we will be covering all the 44 clauses. I'll require 2 sessions, one up to 20 clause and then rest another 20 clause, right? So let's give a brief background. The statement of particulars given in Form 3CD as annexure to the audit report contains 44 clauses. The tax auditor has to, who's the tax auditor, sir? The tax auditor and the statutory auditor can be 2 different people. Absolutely yes. So the appointment of the tax auditor does not require the shareholders' approval on all of that. Unlike your company's auditor, Companies Act auditor, that is a statutory auditor. Tax auditor can be the same person, can be a different person also. The tax auditor has to report whether the particulars are true and correct. Sir, true and fair, it's not true and fair, it is true and correct. This is very important. It has a better this thing, it's not true and fair. This form is a statement of particulars required to be furnished under section 44AB. The same is to be annexed to the reports in Form 3CA or 3CB in respect of persons who carries on business or profession and whose accounts have been audited under any other law, and respect of respect of person who carries on business or profession but who is not required by or under any other law to get his accounts audited respectively. We just discussed this, right? Now let's start with the clauses. The first few are very simple clauses. I'm not going to spend a lot of time here. So name clause, name of the assessee. Under this clause, the name of the assessee whose accounts are being audited under section 44AB should be given. Yes. Clause 2, address clause. The address to be mentioned under clause 2 should be the same as has been communicated by the assessee to the income tax department for assessment purpose as on the date of signing the audit report. So for this you will have to, if you look at your study, the entire text is from the study material, right? If you look at your study material, after every clause they have given some checklist. Now the checklist is very important. I have inserted the checklist into our discussion wherever it is relevant, wherever I feel those clauses are very important, right? For these also you can probably go through your study material and see what is there. If a question is asked, question will be asked on the checklist, what will be the audit procedure that you will perform. So you will need to know what the clause is. You don't have to remember the clause numbers and all. You need to know what the clause is. You will need to know some parts of what procedure you will perform in order to report under that clause. That's the basic requirement under this particular chapter. That's, if you know that, it's more than enough. You don't have to memorize. Don't spend a lot of time in this chapter. Expect around 4 to 6 marks from this chapter, not more than that. There are examinations where nothing has been asked from this chapter. It is highly possible, right? Clause 2. Address clause. The address to be mentioned under clause 2. So it has to be the office address, registered office address, which is communicated to the income tax department. Clause 3, PAN. The PAN of the assessee has to be indicated. Without PAN, tax audit is not possible, of course. Clause 4. Details as to indirect tax registration. Part A of Form 3CD generally requires the auditor to ensure whether the assessee is liable to pay indirect tax like excise duty. Service tax is not there now. You have GST and goods and service tax, customs duty, etc. So wherever you have registered under any indirect taxes. Now there is only one direct tax in India, right, which is the Income Tax Act. There was wealth tax, which is abolished. Okay, apart from that, everything else is indirect taxes. So you have your GST, which is the most common one. Then you have your excise duty, which is applicable for certain products. Your customs duty. All those registration details you will have to give under this clause, right? If yes, please furnish the registration number or the GST number or any other identification number allotted for the same. Thus, the auditor is primarily required to furnish the details of the particular format in which you will have to give, right? And thus, the auditor is primarily required to furnish the details of registration numbers as provided to him by the assessee. The reporting is required to be done in a manner or format specified by the e-filing utility in this context. Clause number 5, status of the assessee. What is status, sir? Not your, not your net worth status. Okay, it is the status of the assessee under the Income Tax Act. If you remember section 2 of the Income Tax Law, multiple plethora of, you have the plethora of definitions. Okay, status here means what are you? Are you an individual? Is the assessee a company? Is the assessee an HUF? Is the assessee a body of individual, association of persons? What is the assessee? So status of the assessee is a very, very important. LLP, is it a firm? Whatever. So you will have to refer the definition of a person under section 2 clause 31 of the Income Tax Act, basis which you will have to refer, you will have to provide an answer, right? This is on clause 5. Next is clause 6. Previous year. So there is a concept, most of you, all of you, by this time should know that there is a concept of previous year and there is a concept of assessment year. If you do not know, please go back to IPCC, your intermediate, right? There is a concept of previous year and there is a concept of assessment year. Okay, in income tax law, this is what it is, right? So we are in the previous year 21-22. Assessment year will be 22-23. Previous year 21-22, assessment will be 22-23. Assessment year will be 22-23. Okay, so 1 year later. So in clause 6, you have to just indicate what is the previous year. Okay, the period of the previous year, basically that particular financial year, right? Of the previous year has to be stated. Don't mistake it to be the actual previous year. Like in common parlance, we have to refer. We have to understand previous year in the context of income tax law, which is your financial year. In the previous year under the Act now uniformly begins on 1st April and on 31st March, the relevant previous year should be mentioned. In case of amalgamation, demergers, reconstitution, new business, closure of existing business, etc., the date of beginning or ending of the previous year may be different. The auditor may accordingly mention the relevant date of beginning and ending of the previous year, and this clause is very, very important clause. Sir, Generally, it is April to March, we all know. So, 1st April 2021 to 31st March 2022. That's what we need to mention. However, if there's a new business, if you bought a business, or if its company is incorporated in the current year, or if it's a demerger, amalgamation, then you will have to mention the start date will be different. End date will be the same, start date may be different. Clause 7 will be in the assessment year. So, similar to the previous year, there will be an assessment. So, 21-22, 22-23 will be the assessment year. Okay. So, what is this assessment year? The meaning of assessment year is the income tax will be assessed of the previous year, will be assessed in that particular year. That's why it's called the assessment year. Right. Clause 8. Under which clause of section 44AB the audit has been conducted. Now, for this we need to understand what is section 44AB. It is a charging section under the income tax law for any assessees to undergo income tax audit, right. So, section 44AB of the income tax law. So, what is section 44AB of the income tax law? There are four clauses and 44ABA, 44ABB, 44ABC, 44ABD, right. So, there are multiple conditions under which you will have to, which has got, and there are a lot of confusion here also. I mean, you need to study your income tax paper, your paper number 7 or paper number 8. You need to study your income tax paper for you to get a better insight, right? But anyway, I am just going through what is there in 44AB. Carrying on business. If the total sales, turnover or gross receipts in the previous year exceed crore of rupees in any previous year, clause A of section 44AB. Provide. So, the general threshold is 1 crore, sir. If my turnover is more than 1 crore, then I am required to do tax audit, right. However, provided in case of a person whose aggregate of all amounts received, including amounts received for turnover, blah, 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 during the previous year, in cash does not exceed 5% of the said amount. So, there could be a question on applicability. There could be a question on applicability of this particular clause. This is clause number 7 that we are talking about. This is clause number 8 that we are talking about, right. So, aggregate of all amounts received, including amount received for sales, turnover or gross received during the previous year in cash, does not exceed 5% of the said amount, and the answer is that's the and clause. So, your cash receipts and your cash expense, your cash receipts and your cash expense during the previous year should not exceed 5%. 5% of what? Aggregate of all amounts received, including amounts received for sales, turnover, gross receipts. So, total receipts. Say my total receipts during the year is 5 crores. My total cash receipts should not be 5% of 5 crores, which is 2.5 lakhs. If that is the case, then this 1 crore shall be substituted with 10 crores. That's all. So, general threshold is 1 crore, sir. General threshold is 1 crore. However, it could be 10 crores. It could be 10 crores if your total cash receipts and your total cash payment does not exceed 5% of the, if your cash receipts and your cash payments does not exceed 5% of the total receipts and total payments respectively. So, you have to consider receipts separately, you have to consider payments separately. So, aggregate of all payments made, including amount incurred for expenditure in cash during the previous year, does not exceed 5% of the said payment. So, your cash receipts by total receipts should be less than 5%. Your cash payments divided by total payments should be less than 5%. Up to 5% is okay, does not exceed. So, up to 5%. If that is the case, then it is fine. Then you can apply for 10 crore limit. So, no tax audit is applicable. So, this is a relief to all the small business owners who have to go through the hassles of doing a tax audit. So, this was a new recent amendment. This could be a question in the examination, right? Carrying on profession, if gross receipts in profession exceed 50 lakh in any previous year, sir. So, this is earlier what we discussed is clause A. This is clause A. So, you have to indicate the clause number 44ABA. So, if you are a business, now what is a business, what is a profession? That's a very grey area, right? Business, the definition is very vast. Business includes almost everything. Profession, and say for example, chartered accountancy, it is, I am practicing chartered accountant, then it's a profession. If you are into business of certain thing, then it's a business. Generally, we also refer to section 44AA of the Income Tax Act for profession. So, assessee has to define, the auditor has to, on a case-to-case basis, what is the business and what is the profession. If it is a business, then this clause will be applicable. If it is a profession, then the other clause will be applicable. The clause says, carrying on profession if the gross receipts in profession exceeds 50 lakh rupees, any previous year. So, if there is no exemption, nothing. If you are a doctor, this clause B will be applicable. If you are a doctor, if you are an architect, if you are an engineer, if you are a chartered accountant, a company secretary, a cost and management accountant, all these are professions. If you are a professional, then for you, what is your what is your threshold? 50 lakh rupees. If it crosses 50 lakh rupees, you will have to do tax audit under section 44AB. Your gross receipts, that is your turnover. Right? Carrying on the business where the profits and gains from the business are deemed to be the profits and gains under section 44AE or section 44BB or section 44BBB and claiming such income to be lower than such deemed profit and gains in any previous year, clause C of section 44AB. This is clause B. Now this is on the presumptive taxation, 44AB clause C. 44AE, 44BB, 44BBB are for special assessees, applying lorries, plying in the business of plying and hiring, all those guys will have to, they have a option to declare their income under these sections 44AE, 44 if it is applicable of course, 44AE, 44BB and 44BBB. Now if I am not declaring that, I am declaring an amount to be lower than such profit. Say for example, the presumptive taxation, the income under, if I am 44A, so for every lorry type there is a particular amount that needs to be declared. Say the presumptive declared scheme is supposed to be 1 lakh rupees. Not let's say 21 lakh rupees. However, I am declaring a 15 lakh rupees because that's my total income. Actual income is this much. Why will I declare 20? Why will I pay tax on a higher income? Then in that case, I will have to do a tax audit. That's what it says. That's what this 44AB clause C is all about. If you are declaring the income to be lower than such deemed income in any previous year. Now, what if I am declaring a loss, sir? Definitely you have to go for a tax audit. Okay. Here the income includes, I mean that's the more, very different people have different stands, but I mean I as a practicing chartered accountant say that if you are declaring a loss, definitely you have to go for a tax audit. Yeah, that's what the section says. Carrying, this is clause D. Carrying on this is the presumptive income under 44AD. The first clause is on business, second clause on profession, third clause is presumptive income for special assessees, that is 44AE, 44BB, 44BBB. The clause number D is for all the other assessees carrying on business, who are claiming under 44AD of the Income Tax Act, carrying on business where the profits and gains from business are deemed to be profits and gains under section 44AD and claimed such income to be lower than such deemed profits and gains, and the income exceeds the maximum amount which is not chargeable to the Income Tax Act in previous year. Now there's some relief over here. What I explained in clause C will hold good. So 44AD, what it says, a 6% if it's everything is in cash, everything is through the bank statement, nothing is through cash. If 6% is my presumptive income, 6% of my total receipts, I can declare it as income on which I have to pay tax. However, if the income that I am declaring is less than the 6%, say my presumptive income is say 10 lakh rupees. If I want to declare 8 lakh rupees, possible sir? Yes sir, possible. I'm not actually earned 10 lakhs, I actually earned 8 lakhs. In that case, I have to do a tax audit under section 44AB clause D. Carrying on the business where the profits and gains from the business are deemed to be the profit and gains under section 44AD and claimed such income to be lower than such deemed profit. What is the deemed profit? That is the 10 lakhs. What is the amount that is claimed? That is 8 lakhs. However, there is only one small relief, and the income exceeds the maximum amount which is chargeable to income tax. For an individual, what is the maximum amount, sir? 2.5 lakhs. So if my claimed income is more than the maximum chargeable limit, that is 2.5 lakh, if it's a normal citizen, Indian citizen, then tax audit is applicable. Sir, I am claiming an income of 1,50,000. Presumptive income is 10 lakhs, sir. I am claiming 1.5 lakhs. Am I required to tax audit? Answer is no, because the second condition is not satisfied. The second condition is not set. So, two conditions under 44AB clause D. For 44AB clause D, there is no such this thing. 44AB clause D, there is a provision. Okay. So, a lot of questions on tax audit applicability have been asked in the examination. Please go through your RTP. There are multiple questions in this area, only in this. Right. So, again I repeat, 44AD, if your declared income the claimed income is less than the presumptive taxation income, then you will have to do tax audit. But there's also one more condition: if your declared income is more than the maximum chargeable limit under the income tax law, only then tax audit is applicable, otherwise it is not applicable. Now, clause 8A, the new clause inserted in part A of form 3CD requires the SEC to state whether the SEC has opted for taxation under 115BA, BAA, BAB, BAC, BAD. Now, all these are sections applicable for companies. BAC is also applicable for other SECs as well. So, these are special taxation incomes. I am sure you guys will know about this if you studied your income tax law properly. These are all special taxation sections where, for example, a company, I know for 115 BAB, and for a company who started its operations post October, right, October of 2020, and it's in the business of manufacturing operations, then they can claim 15% income plus surcharge, of course. Okay, that is 115. However, they have to forego certain the additional depreciation and all of that, right? So that is 115 BAB. BAC is for individuals, right? So there are some special schemes that are available for corporates and for some individuals. BAC, individuals, the new tax regime which we call, which they like to call it, right? So if you are opting for under these special schemes, then you have to mention it over here, clause 8A. Now, next one is clause 9A. If the firm or association of persons indicate name of partners, members and the profit sharing ratio. So, if it's a firm or if an association of persons, indicate the name of partners, members and their profit sharing ratio. That is clause 9A. Clause 9B. If there is any change in the partners or members or in the profit sharing ratio since the last date of the proceeding, that is 31st March, the particulars of such change have to be declared. This is very self-explanatory. Next, clause 10A. So 9 is over, now we are in 10. Nature of business or profession. If more than one business or profession is carried on during the previous year, nature of every business or profession. So we have to say what is the business that you are into. So how many times we've been telling this? Yes, you have to mention it again. Okay. And also if you are into multiple things, multiple verticals, then you have to mention each and everything. 10B. If there is any change in the nature of business or profession, the particulars of such change. So, change from what is declared in the previous year till the current year. If there is any change, then you have to specifically mention, yes, I have changed my business, blah, blah, blah. 10B. Explanation clause 10A and 10B. Since I thought it's important, that's why I've included that also. In regard to the nature of business, the principal line of each business is to be determined and stated in this clause. That is, the sector in which the business or profession falls, such as manufacturing, trading, commission, agent, builder, contractor, professional service sector, financial service sector, or entertainment industry. So you'll have to mention the sector. You don't have to mention I sell this. We fall under the entertainment sector. That is more than enough. In case of a person belonging to the service sector, the nature of each type of service should be broadly stated. Thereafter, the auditor is required to mention the subsector pertaining to the sector selected. So, this is more on if you go to the e-filing utility. So, nowadays, form 3CD, you have to file it online only, correct? So, you will have options. So, you will have to go basis that options only. You don't have to fill it, your manual days are all gone. You have to fill it in the e-filing portal. I am sure you guys will know. Thereafter, the auditor is required to mention the subsector pertaining to the sector selected. Information has to be furnished in respect of each business. The code to be mentioned, again, the nature of business pertains to the main area of the business activity. So, you will have a drop down basis which you will have to fill. Okay. 10B is on change of business, that you have to separately fill. Clause 11A, very, very important clause. Whether the books of accounts are prescribed under section 44AA, if yes, list the books of accounts are prescribed. So, for this you need to know the section 44A. Sir, what does section 44AA talk about? Section 44AA talks about certain notified professional like chartered accountants, doctors, engineers, architects, film industry, film artists, sports person. All these persons have to mandatorily maintain certain books of accounts, which is prescribed under section 44A. The others also have to maintain if the turnover, there is a threshold. If the turnover for the last 3 years crosses 10 lakhs, or if the business profit crosses 1.2 lakhs for last three preceding financial, there is a threshold for that. So that is for other business, other guys. But there are some that is also given in 44AA only. Okay. So whether then after that is 44AB, which is a tax audit clause. So whether the assessee requires to maintain the books of accounts. So you'll have to see the threshold basis which you'll have to assessee has to say whether 44A is applicable or not applicable. If yes, list the list of books so prescribed. So you have to mention what are the books the assessee is maintaining, of course electronically, right? Clause B, 11B, that's the next one. List of books of accounts maintained and the address at which the books of accounts are kept. So nowadays address na manual books is not there. So you have to mention everything is kept electronically. We need to generally keep a side note that boss, everything is kept electronically in a software. That's what we mention in the tax audit clause. In case books of accounts are maintained, a computer system mention the books of accounts generated by such computer system. If the books of accounts are not kept at one location, please furnish the addresses of locations along with details of books of accounts maintained at each location. Very self-explanatory. List of books of account and nature of relevant documents examined. Sir, this is this is on the auditor. What are he maintains books of accounts. What are the ones that you examine? Mostly everything we will examine. So we'll have to say, boss, we've examined everything, or whatever we've not examined, we'll not examine. So we may not have examined certain things. So you'll have to say, this is what I have examined out of 11B, right? Clause 12. Now this is on the presumptive taxation. Presumptive income scheme. Now we all know about there are multiple schemes of 44AD, 44ADA, 44AF, BB, BB, BBA, BBB, Chapter 12G, first schedule, so many depending upon the activities that is carried on by the taxpayer, right? Where the profit and loss account includes any profits and gains accessible on the presumptive basis. If yes, indicate the amount of the income and relevant section. So I would like to ask one question to the audience. Sir, if I have two sources of income, I want to declare two businesses. I say I'm a salaried person. I'm also doing some consulting work as well on a part-time basis. Consulting, I want to salary 44AD is not possible because it is salary. It is not even business income. The other income is consulting income. Can I declare it in 44AD? Answer is absolutely yes. You can declare it under 44AD. The consulting income, salary income can be shown separately. So suppose if a tax audit is applicable to me, then I will have to do 44AD. I'll have to show out of the total income how much I am declaring into presumptive taxation. That is what is this clause talking about. Clause 13A, method of accounting employed in the previous year. So there are two methods of accounting, cash accounting and mercantile system of accounting. So this is very important. I mean, I would like to tell you guys, I mean, I'm sure you guys will know this, but see, if you are a company, you are mandatorily required to maintain the books of accounts under the company law, of course, but under mercantile system of accounting. If you look at section 128 of the Companies Act, it will say you have to follow the mercantile system of accounting, point number 1. Point number 2, double entry system of bookkeeping have to be maintained. No single entry is possible. However, under income tax law, there are no such provisions. If an assessee wants to maintain books of account basis cash system of accounting, that is allowed under the income tax law. So if a proprietor is maintaining books of accounts on cash basis, absolutely no problem under income tax law. Just that you have to be consistent here, and you cannot keep changing your your way of maintaining books. Alright, so it is of course preferred to have it under a mercantile law, but if you are maintaining it under your cash system, that is absolutely okay. So that's why this clause 13A is given. Clause 13B, whether there has been any change in the method of accounting employed vis-a-vis the method employed in the immediately preceding finance. So last year cash, now mercantile, last year mercantile, now cash, you have to mention it here. Because that will have an impact on the income, that is why. If answer to B is yes, answer to B above is in affirmative, that is yes, that is a change, give the details of such change and the effect thereof on the profit or loss. Of course, so basis that they will send a notice, okay, boss, this much extra profit is there or extra loss is there, please pay tax, right? So serial number, particulars, increase in profit, decrease in profit, you will have to mention that. Clause 13D, whether any adjustment is required to be made to the profits or loss for complying with the provisions of ICDS notified under section 145 subsection 2. So in today's income tax law, how many standards are there? There are 10 ICDS standards. Okay, ICD, income tax computation disclosures. It was a huge roar when it came out in the year 2017. ICDS, what is going to happen? Now these standards are just, they are not accounting standards. Let's not confuse ourselves with the account. This will be there in your income tax paper, right? So income tax computation and disclosure standards, your ICDS, some of you would have studied, some of you would have left it in choice, whatever it is, right? So from an audit standpoint, you don't have to know them. Like if at all a question is asked, then yes, but unless otherwise you don't have to know them, right? ICDS, income tax computation and disclosure standard, are only for computation of income tax and disclosure of income tax disclosure or filing your returns. They are not, don't confuse yourself with the accounting standard. So if at all you are performing your audits, I mean say you are a listed entity right, you have to follow Ind AS. Now, the provisions in Ind AS and the provisions in ICDS are different. So, as simple as you have a derivative contract, the way you treat it in Ind AS and the way you treat it in ICDS is different. But when you return your income, when you file your income tax returns, again I am repeating, you will have to follow your ICDS. So that effect has to be adjusted. So from your book profit, you will have to reduce the income that has been shown as per Ind AS, and you have to add the effect of ICDS. So that is why ICDS is into play, right? So there are 10 account ICDS. Now ICDS is, most of it is similar to your accounting standards, your AS, but there are a lot of differences as far as Ind AS is concerned. So this is more applicable for listed entities. This is more applicable for listed companies where there is a difference in the gap. ICDS and your Ind AS and your ICDS, and therefore the change has to be quantified and has to be given effect to while filing your returns of income. If answer to D is affirmative, give details of such adjustment. So if there is any adjustment as far as ICDS is concerned, we will have to give a clause here. So name of the 10 ICDS, name of the this thing, increase in profit, decrease in profit, net effect. Clause 13F, disclosure as per ICDS. So what is there are some disclosure requirements that we will have to follow, which we will have to give as per clause 13 clause F. So 12, so we have discussed how many clauses? 13 clauses have been discussed so far. Then we go to 14. Now clause up to this, these are very simple basic questions, as far as 3CD is concerned. More on the accounting side, name of the SEC, address, indirect tax details. As you go further, the complication will slightly increase, right? Clause 14A, method of valuation of closing stock employed in the previous year. Sir, again, let's not confuse ourselves with what is given under AS2 or Ind AS2, right? Let us not confuse ourselves with that. So, under AS2, method of valuation of closing stock. Now, here, what do you mean by this method? So, a cost or NRE, whichever is lower, or you can follow FIFO, LIFO. LIFO is not allowed as per AS, but Income Tax Act does not give any restriction. I mean, ICDS, yes, now there is an ICDS, this thing, in ICDS 2, which talks about, you need to follow this method and that method. But it says cost or NRE, whichever is lower. However, there is something called, now see, generally GST or your excise duty at that point in time, or your service tax, is not added to the stock because you are able to claim rebate of it. Customs, yes, you can add, you have to add, but this one you cannot add, right? So, ideally that's what we do in across everything, but there is a possibility, there are, I mean, if you look at the guidance note on tax audit, so if at all you do it, if you add GST also as part of your closing stock, then how you have to show your income here? That is what this clause 14A and 14B talks about. Details of deviation, if any, from the method of valuation prescribed under section 145A and the effect thereof on the profit or loss, please furnish. So under 145A, which is your ICDS standards, right? Method of valuation prescribed under 145A. So you will have to see whether whether there is a closing stock declared under closing stock that you are using to value for your books of account for preparing your audit, and what is prescribed under 145A. If there is a change in the same, then this has to be done. There is a detailed guidance available in the guidance note to tax audit. I mean, though it's not important from an examination perspective, I mean, most of you, I'm sure you would have gone through it, because a lot of people follow the general norms, okay, but some people add the GST, some people add excise duty, if at all they're adding, then that will fall under this purview, and then clause 14B will be triggered, right? Clause 4, ascertain the method of valuation of stock employed during the year, whether there is, now this is an explanation, whether there is a change in the basis of determining cost, market value or net realizable value. Even though there is no change in the method of valuation, the same should be reported under clause 14. So even if there is no change, so if you go to clause 14A, method of valuation of closing stock employed, so you have to just mention whether there is any, whether what is the method. Even there is no change, still you have to report this. Where there is a change in the method of valuation, then determination should be made of direct effect of such change in the profits for the year, and disclosure should be made under clause 14. Ascertain from the management the method adopted by it for valuation of closing stock. Obtain from the SEC inventory valuation sheet of the stock in trade, giving quantitative details, method of valuation, rate and total value of each item. Stock records, now this is a checklist basically. Stock records should be checked for opening balances, receipts issued and closing balances. So basically quantitative reconciliation has to be done. Comparison of the balances as per stock records should be done with balance obtained for physical verification. Any discrepancies between the two should be rectified, or should be rectified. Inventory valuation sheet should be checked thoroughly with regards to quantities, rates, methods of valuation and calculation made. If there is any change in the method of valuation of closing stock from the last year to the current year, FIFO to LIFO, FIFO to weighted average price, whatever it is, then the fact and the effect of the change would have to be disclosed as per the requirements of clause 14. So that is your clause 14b. Right? If the assessee is not maintaining any stock records, then ascertain on what value of stock has been, what basis the value of stock has been arrived, state the fact in the audit report. This is very important. So, a lot of these small individuals, businesses, they have no clue of what the stock is. They do not maintain, they just purchase and they sell, they purchase and they sell, they purchase and they sell. There is no maintenance of stock at all. There is no maintenance of, no proper records that are being maintained as far as, the stock is concerned. So, in those cases, the fact that there is no stock being maintained has to be reported by the assessee, by the auditor. Yeah, if possible, depute persons to attend stock by the assessee to review the process. Otherwise, take a detailed look at the notes on stock taking and the instructions issued to the stock taking personnel. If possible, depute persons to, so this is required as per the accounting standards also. By the standards on auditing also, SAs. If you remember SA 501. Audit evidence specific considerations for selected items, there is a specific requirement to attend physical taking of stock if the inventory is material. So, from a stock audit perspective, audit is no different. Audit is same in Income Tax Act as audit is same in Companies Act. We have to do the same set of audit procedures. The accounting may be different, but the audit is absolutely the same. So, if possible, depute persons to attend stock taking by the SE to review process. Otherwise, take a detailed look at the notes on stock taking and the instructions issued to the stock taking personnel. Now, the management issuing to the stock taking those notes. But ideally, if the inventory is very material, please attend stock taking. That's very important. Now, that was on clause 14a. 14b. Review the method of valuation adopted for valuation of closing stock and compare the same with the method prescribed under section 145A of the Income Tax Act. Ascertain whether the method of valuation is such that the value of closing stock includes the amount of any tax, duty, cess or fee actually paid or incurred by the SE to bring the goods to the place of its location and condition as on the date of valuation. So, ideally no company does it. In my experience, I have not seen any companies taking into account GST and all of that and including it in the closing stock. But if at all they are doing it, that has to be rectified. Pay particular attention to the following: that the duties paid in respect of goods cleared have been included, that the duties payable in respect of goods held in bond have been included. Check that the opening stock of raw materials, purchase price of raw materials, closing stock of raw materials, including all taxes, duties, even though they are refundable in nature. Okay, so ideally if it's refundable, then you will not include it. If it's non-refundable, then you will include it in the part like custom duty. You cannot get a refund. You will have to exclude it. You have to include it in the cost of the product, right? Ascertain whether there is any deviation in the method of valuation of stock as compared to the provisions contained in section 145A of the Income Tax Act. If yes, then ensure that the fact as to deviation and effect of such deviation on the profit or loss is adequately disclosed. So, 145A prescribe, basically 145 subsection 2 and 145A is your ICDS. They prescribe certain methods, cost or NRV which is lower, FIFO and WAP. If you are not following that, then you will have to disclose that yes, there is a deviation and the effect thereof on the profit has to be disclosed as part of clause 14b. Clause 15. Give the following particulars of capital assets converted into stock in trade. Now, this is a very important from a capital gain perspective. I'm sure you guys would have studied your capital gain. So, a capital asset converted into stock. It's, sir, I had a land or building. I was owning it, sir. Now I am getting into a real estate company and now it becomes my inventory. So there are provisions as to how you will take that conversion. What is the cost from an income tax angle? What is the cost at which you will take, at which you will value that particular closing stock? So so if there are such cases, then you'll have to give a description of that, right? Description of capital asset, date of acquisition, cost of acquisition, of date now at that time, what time you bought the asset, right? Capital asset, amount at which the asset is converted into stock in trade. This you have to take guidance under section 50 CA, if I'm not wrong. Amount at which asset is converted into stock in trade. This is clause 50. Now this may not be applicable for all SECs, may not be applicable only when you convert your capital asset into stock in trade. Clause 16, a very important clause. Amounts not credited to the profit and loss account being the items falling within the scope of section 28. Now this section is, this clause 16 is where the assessee has to report, or the auditor has to report any clauses, any income, any receipt which is in the nature of income, under what we are going to discuss, which is not credited to the P&L account, If it is not credited, then of course it will be taxed separately. This will be helpful for the tax auditor. This will be helpful for the income tax department to kind of issue notices to the auditor, to the assessees. Okay, boss, this is not credited to your P&L, therefore you have not included it, and therefore you need to, you need to pay tax on that, right? Items falling within the scope of section 28 is a huge area. We'll have to discuss this separately. I'm sure you would have gone through your Income Tax Act. Section 20 discusses the plethora of incomes which are not falling, like bad debts recovered, so many things are there, right? All that has to be taken to the P&L. Pro forma credits, drawbacks, refund of duty of customs, so any GST refund, okay, all of that which is not taken in, which you have not, which is not taken to the P&L. So pro forma credits, drawbacks, refund of duty of customs or excise or service tax or refund of sales tax or GST, where such credits, drawbacks are admitted as due by the authorities concerned. So admitted due, you have got this thing, yes, we have to pay. Information, yes, we need to pay GST refund, but paisa has not come, the money has not come yet. So in that case, ensure that is taken to the P&L. So if, say for example, income tax itself, you need to get a refund. We will generally in accounting standards say unless you don't get the money, you should not recognize the income. If that is the case, then you will not recognize. Now here this is more on the indirect taxes, not the direct tax. I'm just giving an example of a direct tax, but any credits or drawbacks, you should take it to the P&L directly. Escalation claims accepted during the year. So if more and so on the construction contract, like if there is increase in raw material prices and then an escalation claim, this has to be taken into account. If it is accepted, it has to be taken to the P&L, as it may not be credited. Most probably it is not credited to the profit and loss account. If it is not credited, we need to put it here. Any other item of income, very, very general. Any item of income which is not taken to P&L, please report. Capital receipt, if any. See, generally itself capital receipt we will not take. Okay, that's as per the accounting standard itself, we will not take. Suppose I am selling an asset, I may not take it into account, or I am getting a grant, receipt, capital, I am getting a grant. Will I take it to the P&L? Answer is no, I will put it in the reserves, right? If that is the case, I have to report here. But is it whether it will be taxable? See, my answer is only to report. My duty as an auditor is only to report what is given. I just have to blindly follow the checklist. So here the capital receipt, so it is not required to be credited. Absolutely it is not required to be credited. But the question is not about whether you are complying with the accounting standard, not complying. Question is capital receipt is there, not credited. Yes, put the number here and close it. Clause number 17. Where now we discuss in clause number 15, capital asset being converted into land. Capital asset being converted into land. Now it is vice versa. Capital asset being converted into stock in trade. Now it is vice versa. This is when any land or building or both is transferred during the this is not that. This is some other section that will come later. What we discussed in clause 15 is from a capital asset it is being transferred to stock in trade. From a capital asset it is being transferred to stock in trade. Again I repeat what we discussed. You have a land or building, you want to start a real estate company, you want to sell this, so you are taking it as a stock in trade now. You are making it as an inventory. Now this is a different this is under section 43 CA or 50 C. So when any land or building, immovable property or both is transferred during the previous year for a consideration less than the value adopted or assessed by any authority of a state government, refer to section 43 CA or 50C, please furnish. Sir, what is this, sir? Sir, I have transferred land. Again, you should know this 43C, 50 is very important from a final paper, an inter paper in your income tax law. Okay. See, I am not dwelling much into these sections because I am assuming that you will have some idea on it because you would have studied your income tax paper. Anyway, so where any land or building or both is transferred during the previous year for a consideration less than the value adopted or assessed or assessable by any authority of a state government referred to in section 43 CA or 53C, please or 50C, please furnish. Details of property. Consideration is, I am selling a property for 50 lakh rupees or 1 crore rupees. Value adopted is 1.5 crores. That has to be reported. Whether provisions of second proviso to subsection 1 of section 43 CA or fourth proviso to clause 10 of subsection 2 of section 56 applicable, yes or no. 5610, 56.210 is your other sources of income where you have received the land for less than the fair market value, then you will have to refer this. Then you have to, whether you have complied with or not, whether those will be applicable, not applicable, yes or no. So, for example, this this could be a case study in the examination. They can give you a case study and ask you to say how will you report this in the exam in as per clause 17. Now, you have sold a land or a building, okay, for a say you have sold it for 50 lakh rupees or 5 crore rupees. Yes. However, the guideline value, that's what is this adopted less than the value adopted or assessed is basically the guideline value. The guideline value is 7 crore rupees. Ideally, you should not do. So, you have to pay capital gains on 7 crores and not 5 crores. You have to pay though your actual sales is 5 crores only, sir, but you have to pay, see what these sections will say, guideline value is the base. So, if your guideline value is 7 crores, you are selling it at 10 crores, then declare 10 crores actuals. But if your actual is less than the guideline value, then you have to declare the guideline value for the computation of your capital gains. So, in any case, if you have sold it at less than the guideline value, if in any case where you have sold any immovable property, transferred any immovable property at less than the guideline value, then you have to which referred to in section 43C or 50C. Both these sections talk about that only. You have to furnish the details of that. So, the details of the property, consideration, value adopted or assessed or assessable, and whether provisions of 43CA and 56.210 talks about that only. Whether you have sold your immovable property as less than that, and 56.210 will be applicable. The buyer also the excess will be charged, the seller also it will be charged. From both sides it will be, buyer will charge because 56.210 will be applicable for the one who is selling the property. He is incurring a loss. He is selling a property of 7 crores for 5 crores. So, he is incurring a loss for some reason. So, for the buyer who is buying the property is incurring a gain, but he is declaring only 5 crores as income, and therefore, he will have to pay tax on the additional 2 crores. That is the section, that is the law in India. You cannot sell at a price which is less than the guideline value. Clause 17. Clause 18. Particulars of depreciation, very straightforward, sir. What is the depreciation? This is very, very important because that's how you create, you kind of declare you compute your deferred tax also. What is the depreciation block by block as per the income tax? The depreciation as per income tax law and depreciation as per company law is very different. Okay, if you're not a company, you can follow any rate. Generally, we follow the income tax rate. Okay, so you have to, and there's a way to compute depreciation under the Income Tax Act. Okay, less than 180 days, more than 180 days, less than 180 days, 50% of the amount, more than 180 days is at total depreciation is allowed. Okay, then additional depreciation, all of that is there. So, particular of depreciation allowable as per the Income Tax Act in respect of each block or block of asset. So, description rate, generally you give a schedule, you cannot give because there are multiple blocks. Actual cost or written down value, adjustment made to the written down value under section 115 BAC, BAD for assessment year 2021 only. That year is already passed, so we don't have to worry about it. And basically, this is your 15 BSc BAD. You have to adjust everything. Now, that if you are taking a special income, you have to adjust this. So that's why it is applicable, right? Again, it is only for 21-22, so it is not applicable for your, not more relevant for you. It will only be applicable for 21-22. Adjustment to be made in return of intangible asset due to excluding value of goodwill of a business or profession. So, if you have recognized goodwill of this thing, then you have to make an adjustment to return down value of intangible asset. adjusted written down value, additions, deductions during the previous year with dates in case of any addition of an asset, date put to use. So for additions you have to give a complete list. Okay, what is the addition, what is the total, what is the date put to use, right? Change in rate on account of central value added tax credits and allowed under central excise rules instead of assets acquired on after 1st March. Change in rate of exchange, all this will not be possible, and subsidy, grants or reimbursement by whatever name called. Depreciation allowable, return on value at the end of. So you have to have a schedule, sir. Opening, additions, depreciation, closing. For your additions, you will have to give us a list of all the additions asset wise. Having regard to the nature of requirement prescribed, it may be necessary for the tax auditor to examine the classification of asset, classification thereof to a block. Hold on. Classification thereof to a block, working of actual cost of written down value, the date of acquisition, very important, we need to check on a sample basis the date on which it is put to use. Now, this is very important, put to use, ready for use. Ready for the put to use is where, say for example, this particular very standard example, AC. AC, I have bought it, sir, not yet installed. Whether I can say it is put to use? Answer is no. I have not installed it yet. Only when I install it, when I install the AC, then only it can be said that it is put to use. However, fire extinguisher is an asset. I bought 15 fire extinguishers for the plant, but extinguishers will I use every day? Every day there is a fire? Answer is no, there is no fire every day. It is so I have just put it there. So it is said to passive put to use, also put to use. That's what I mean. You may not use it, you may not have to actually use it. But if it is kept for use, then it is said to be put to use. That's what it means. So on a case to case basis, you have to use common sense and you have to we'll have to see what should be the date it is put to use, because basis this date only the your depreciation is allowed. So therefore it is very important date. Applicable rate of depreciation as per the Income Tax Act Schedule 2. Addition, deduction and dates thereof. Adjustment required specified as well as account of sale, etc. Sale you have to reduce it directly from the block of asset, and there is no like accounting, you have to reduce the net book value, nothing like that. Entire sale value just deducted just like that from this thing. Clause 19. Sir, this is a plethora clause, a big clause, sir. Amount admissible, very unlikely that this will be asked in the examination. It's been going on since years. Okay, when I was doing my articleship, this clause has been there. Amount admissible under sections. Admissible. So if the assessee is claiming these scientific research, medical association, grants to medical, this thing is claiming any expenditure. So should I know all the clause? Answer is no, you may not know. Just the brief you may know. See, it's not an audit, they will not ask you a very detailed question around this. Okay, they'll ask you very simple questions, as far as income tax is concerned, because it's not an income tax paper. Okay, but you need to have some basic sense of what these sections are all about. So basically what you need to say is amounts admissible under section. So what is the for example, let's take this 35 subsection 1 clause 1. 35 section 35 itself is scientific expenditure. 100% reduction allowed. So if I have debited say 50 lakh rupees here in the P&L, how much is the amount that is admissible? So it will say to 100%, so 100% is admissible. Now there are sections that give 200% as deduction. So I have to say debited is 100 lakhs, here I have to mention 200 lakhs in this particular column. That's what it means, right? So you'll have to give a list of sections. List of, if the assessee claimed any benefit of under these sections. Clause 20, yes sir, very important clause, sir. Any sum paid to an employee as a bonus or commission for the services rendered where such sum was otherwise payable to him as profits or dividend. Section 36 clause 1 subclause 2. Again I repeat this. So clause 19 we discussed. Clause 19 is this is clause 19. Clause 20, sir, I am paying you any sum paid to an employee. I am the employer. Assessee is the employer. I have paid you a bonus. I have paid you a commission. Any sum paid to an employee as a bonus or commission for the services rendered, where such sum was otherwise payable to him as profit or dividend. So so why is this so important? I mean, what is the purpose of this clause? That is more important to understand. See, bonus, commission for services rendered, I would have paid some money, but however, if I have to, where such sum was otherwise payable to him na, the employee, him means here the employee, right, where such sum was otherwise payable to him as profits or dividend. This could be on account of ESOP or any ESOP that I have to share, but instead of giving him ESOP, I have given him a bonus or a commission, then that has to be reported. That is given under section 36 subsection 1 clause 2. Clear? So any bonus or commission which I am not supposed to pay him as a bonus or commission, see, there will be, for that you have to check the offer letter, you have to check the you check the appointment letter in which bonus everything will be there, or check the appraisal letter as the increment letter as the case may be. If the bonus is paid as per that, then I have to pay him as bonus, I am paying him as bonus. But however, amount that I am supposed to pay him as a profit or a dividend to the employee, but I am paying him as a bonus or a commission, any sum paid to an employee as a bonus or commission which was otherwise payable to him as a profit or dividend, then that amount has to be reported under this particular clause, because for which I would have claimed a deduction. That is what it means, which I should not have ideally. Audit checklist for practical understanding. I've just, see, if you look at your study material, for under every clause there is a checklist given, but I have not included for everything, because for certain things very self-explanatory, you can go through. I mean, let's not spend a lot of time on studying the audit checklist, you can go through on your own. For certain things I felt, okay, these clauses important, could be asked in the examination, I have included, right? Obtain a list of employees eligible for bonus or commission for services rendered with amounts. Check the basis for calculation of bonus or commission for services rendered. Obtain a management representation that the sum paid to the employee as a bonus was not payable to him as a profit or dividend. That is, so for some employees I may have a agreement, because if this contract is coming, then I will give you 5% on the profit that I make, then that is payable to him as a profit, not as a commission or a bonus. Such agreement, so we need to understand that, and we need to see how it is been shown in the books of accounts. The auditor should obtain from the assessee particulars of the expenditure incurred on bonus paid to the employees in the following format: description of the person, that is the employee, bonus amount, expenditure not considered as bonus, description, remarks. Check the accounts for commission, bonus, salary and wages, staff welfare to ensure that all bonus and commission paid to employees have been included in the statement and employee contracts on sample basis. Details of commission paid to employees should be furnished as under. The auditor should check whether bonus and commission paid to employees for services rendered, whether otherwise payable to them as profit or dividend. If yes, then report such payment. So, you have to pay bonus to the employees as per the contract that you have entered with the employee, bonus or incentive or commission. If you are paying them profits, but you are coloring them in the nature of bonus, then that has to be reported under clause 20 subclause A. That is what this means. Clause 20b, details of contribution received from employees for various funds referred to in section 36 subclause 1 clause 5 36 subsection 1 clause 5a. Sir, what is this, sir? Basically your PF, ESI, your PT, all of that. So any details of any contribution received from employees for various funds. So what is the serial number? What is the nature of fund? PF, ESI. Some received from employees. What is the amount? So basically you need to get your PF challans, your PT challans, your ESI challans. You need to see what is the employee contribution, because see, what are you doing? You are, instead of giving the salary, you are deducting, you are including one amount. That's a different thing. So there is an employer contribution and there is an employee contribution. This section talks about the employee contribution. So the salary is 50,000 rupees. Out of the 50,000, say you are deducting 1,500 rupees. So that 1,000, and you will also contribute 1,500 rupees. This is not the subject matter of discussion. This is the subject matter of discussion. This is 1,500 subject matter of discussion. So actual amount pay, because this section 36 clause 1 subclause 5a talks about if you are not remitting it on time, then that may be disallowed. So that is why these details have been asked. 36 subclause 1, received from employees for various funds as referred to in section 36 subclause 1 clause 5a, right. Some received from employees, due date for payment, the actual amount paid and the actual amount of payment to the concerned authority. Actual amount of payment when it is received and when it is paid to the concerned, that is a PF and ESI authority. Right. So this you need to mention. This is very, very important disclosure. Clause 20. Now this is a huge clause. This is on the TDS. Clause 21 is on 21A is on TDS. Please furnish the details of amounts debited to the profit and loss account being in the nature of capital, personal, advertisement expenditure, etc. Sir, capital expenditure is not allowed as per the Income Tax Act. It has to be disallowed. So therefore, we need to mention that. So basically for this, we need to scrutinize the repairs and maintenance expenditure. We need to understand what is the nature. We need to identify whether it's capital in nature or it is revenue in nature. If it is revenue, fine. If it is capital, then we'll have to capitalize it and not expense it off. Personal nature, sir, especially when you are doing audit of, doing tax audit of sole proprietors, what they will do, their personal expenditure also they will put it in the P&L, like your school fees, marriage expenses, all of that will be there. So all that has to be mentioned here because that will be disallowed while computation of income tax. Only business expenditure is allowed as per section 36 of the Income Tax Act. Advertisement expenditure incurred at club, because again there are specific provisions on this. Expenditure incurred at club being cost of club services and facilities used. So all of that has to be specifically mentioned here. Okay. Now one more thing, if it's a corporate, for a company, what is the personal expenditure, sir? For individuals, okay. For a corporate, what is the personal? Say director's expenses. If it is not in line with the employment policy or with the policy, with whatever the agreement is with the director, then it becomes a personal expenditure. For example, a director's daughter got married and all the marriage expenses were debited to the P&L of the company, then it becomes a personal expenditure. That's what it means. Expenditure by way of penalty or fine for violation of any law or for time being in force. Expenditure by way of any other penalty or fine not covered above, because see, generally penalty or fine for violation of any law or for time being in force, what happens is it may get disallowed because it is not in the nature of business. So not in the nature of this thing. So therefore it becomes important that we disclose it. It could be a late fee, it could be a penalty, whatever it is, we need to mention it over here, right? Then it is up, see, it depends on a case to case what stand we take, right? Expenditure incurred for any purpose which is an offense or which is prohibited by law. So the auditor will have to understand whether say you paid some fine, you paid some penalty which is paid in the penal, that has to be disclosed over here. Clause 21B, amounts inadmissible under section 40A. Now the overall scheme of this clause is 40A1A. Basically, if you are not deducting TDS on any expenditure, then the same will have to be disallowed. For if it's a non-resident payment, 100% disallowance. If it's a resident payment, then 30% of it will be disallowed. So for example, I am paying to the auditor and I have not deducted TDS. So auditor fee is 1 lakh rupees, no deduction. Generally TDS deduction is 10%. If you're paying 90,000, I paid 1 lakh, then 30% of that 1 lakh will be disallowed for the purpose of computation. Only later on when I pay TDS in the next financial, only at that time that 30,000 will be allowed for computation of income tax. So as payment to non-resident referred to in subclause IA. So details of payments on which tax is not deducted, these are the details that you will have to furnish. Details of payments on which tax has been deducted but has not been paid. So both, I have deducted tax, sir, and not paid. Sir, I have not deducted at all. So both things will have to be furnished. Similarly, IA 40A1A is your resident payments. Same disclosures have to be given. Subclause IC is for fringe benefit taxes. Subclause, all these are 40A1, all these are different subclause which talks about TDS only. 40A1, 40A1A, all these talk about your TDS only. Subclause 2B, subclause 3, date of payment, amount of payment, name and address of the payee. Under subclause 4, see, you don't have to, you just have to mention overall scheme. You will have to know that if I am not deducting TDS for any kind of payment for which I am supposed to deduct, that entire amount will get disallowed for the purpose of computing Income Tax Act. Subclause 5. Clause 21C, amounts debited to the P&L being interest, salary, commission or remuneration inadmissible under section 44B or 44BA and computation thereof. I am sure you guys will know about 44B. If you are a partnership firm or an LLP, your partner's remuneration, there is a limit, right? 90% for the first 1.5 lakh rupees, it is, sorry, for the first 3 lakh rupees of your book profit, 90% or this thing, which 1.5 lakh, whichever is higher, and then for the remaining 60% is allowed. So more than that, it is completely disallowed. It will be taxed in the hands of the firm, right? So if you have taken your remuneration is more than that, right? So that has to be computed and that has to be shown. That is clause 21C. This is applicable only for partnership, for firms. This is not applicable for others. If it's a company, this is not applicable. Disallowed or deemed income under section 40A3, that is your cash payments in more than 10,000, payments other than your account pay by bank or account pay draft, that will be disallowed. That's more than 10,000, or rule 6DD. You have to mention it in this particular form. All these are very simple ones. I am not going into detail. 40A3A, on the basis of examination of books of accounts and other relevant documents or evidence, where the payment referred to in section 40A3A read with rule 60D, where made by account paid check or a demand draft. If not, please furnish the details thereof. So 40A3 is on the on 40A3 and 40A3 both talk about cash payments. If you are making any payments by cash more than 10,000 rupees, earlier it was 20,000, now they brought down the limit to 10,000. If you are making payment more than 10,000 rupees, in that particular case, you will have to pay to different parties on the same day, to the same party on the same day, then that entire expenditure will get disallowed. I included clause 21E, payment for provision for, if you are making provision for gratuity is disallowed, only actual payment of gratuity is allowed. So that entire amount will get disallowed under section 40A clause 7. 21F, any sum paid by the SSC as an employer not allowable under section 40A 9. Clause 21G, particulars of a liability of a contingent nature which is taken to the P&L. So if it is a liability of a contingent nature not going to happen, that may be disallowed for the purpose of computation of Income Tax Act. 21H, amount of deduction inadmissible in terms of section 14A. So any there is an income, there is a corresponding expenditure. Income is exempted, expenditure also has to be removed for purpose of computation. That is what is this rule 14A talking about. 21I, amount admissible under the provision of section 36(1) clause 3. Basically 36(1) clause 3 is on the interest on borrowed fund, that has to be capitalized and that should not be taken to the P&L. That is what is 36(1) clause 3. Interest for a fixed asset, loan for a fixed asset, the interest has to be capitalized till the asset is put to use. Now this one illustration which I had given, which is from this thing, you can probably, this is an important illustration. Questions like these can come from the examination. Questions like these it's basically the payment that is made, how will you treat it? If it is more than 10,000, 5,000, you have to go through, the question and then you'll have to answer. Right. So if you look at this as per section 40A3A of the Income Tax Act, when allowance has been made in the assessment for any year in respect of any liability incurred by the SSC for any expenditure and subsequently during any previous year, SSC makes a payment respect thereof, otherwise than by an account pay check drawn on a bank or account pay bank draft, the payment so made shall be deemed to be the profit and gains of business or profession, accordingly chargeable to income tax as income in the subsequent year. If the payments made to a person exceeds rupees 10,000, rupees 35,000 in case of, so 40A3 is 10,000. If you are in the business of plying hiring, that's a little more higher, 35,000 is the limit, right? So if I am making the payment, I'm making the payment for expenditure, I'm making the payment right now, then that entire to the same party on the same date which is more than the limit, then the amount will be disallowed. So that's actually very difficult to kind of practically identify. You need to take the entire cash ledger and we need to see any payments more than 10,000 rupees and then we'll have to report the same. Right. So I'm skipping through this illustration because it's available in your study material. You can probably, why I have included that, because I want you to even go through the illustration. That is why I had included it. Clause 22, amount admissible under section 23 of the MSME Act, amount inadmissible. Now we all know this MSME Act, there is a section, there is a interest section for inadmissibility, amount inadmissible under section 23 of the MSME Act. Any interest that is accrued, for late payment, under the MSME Act, that will be disallowed as per the Income Tax Act. So that is what we need to mention over here. Section 23 of the MSME lays down any interest payable or paid by the buyer in accordance with the provisions of this Act shall not, for the purpose of computation of income under Income Tax Act, be disallowed as a deduction. So any provision that you make, any interest that you are paying as per section 23 of the MSME Act, it has to be disallowed. It should not be taken into account. So with this clause, with this your 22 clauses I have covered. There are other clauses also, I mean, which needs to be covered, right? So please go through your study material. This is very important. If you do not go through your study material, I mean, one question will definitely come from the examination. Okay, there are other, I told you 44 clauses, 22 we have gone through. Other clauses we'll do it in the next session. Let's take a break of 15 minutes and then let's join back and start the next session. Thank you.